Regional airline Rex falls into administration. BHP spends $3 billion as it chases copper assets in South America. And Chinese buyers rush to purchase Australian wines. Welcome to Fear and Greed, daily business news for people who make their own decisions. It is Wednesday, the 31st of July, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, the main story this morning, Regional Express has fallen into administration with the airline's board agreeing to ground flights between capital cities and focus on regional travel.
EY will act as the administrator, and Virgin Australia has moved to quickly secure 3 leases over aircraft from the flailing airline, better known as Rex. Virgin will also step in to fly passengers booked on flights that Rex cancelled late last night. After a board meeting, the announcement was made. Now, in a statement, EY said, and I quote, Virgin Australia has made an offer for Rex customers with an existing ticket on a flight cancelled due to the administration process the opportunity to transfer their ticket free of charge to the 13 overlapping Virgin Australia services. Rex and Virgin Australia are also exploring opportunities to support regional customers, which include Virgin Australia selling Rex's regional services through code share or interline arrangements and making Velocity frequent flyer benefits available to Rex's regional customers. Virgin then came out later in the evening and said it would support Rex's employees who could apply for jobs at the airline, as well as via code sharing and interline, that's ticket selling, interline agreements on the remaining regional flights. It all came after a very busy day. The Prime Minister, Anthony Albanese, was asked it before this announcement. He conceded that the government is speaking to the airline about the issues it's facing. He wasn't very clear, though, whether it will support financially. Now, asked whether the government was ready to bail out Rex, Mr Albanese said the airline had already received substantial government support with no conditions attached. He said the government would look at any proposal put forward by Rex, but I'm sure we'll find out more about that in coming days.
This has really been quite the saga, hasn't it? With the executive chairman, Lim Kim Hai, who controls around 50% of shares, being forced to step down last month.
It has been an incredible saga. The board, including a long-time associate of Mr Lim, was unanimous in its decision to replace him as chairman after ASIC queried a related party transaction with Mr Lim's brother-in-law and Rex's acquisition of fly-in, fly-out operator National Jet. There's also been a vote to spill all board members, except for one who happens to be a representative appointed by private equity firm PAG. Now, PAG invested in Rex in November 2020 and is its main financier. It has a right to 2 board seats under the terms of its $150 million investment, but it only utilises one. However, it is now pushed for that spill of the board away from the boardroom. Analysts say its regional operations have been solid, but the decision by Rex to buy 9 Boeing 737 jets from Virgin when that airline went into administration and start flying the Brisbane, Sydney, Melbourne triangle just hasn't been successful. Recently, it added a Melbourne to Perth route, $99 fares. Maybe they were too low. Rex's travails come after low-cost carrier Bonza collapsed earlier in the year. The outlook for Rex does not look promising.
Yeah, that sounds about right, Sean. After the show, you have an interview coming up with, this is a great chat, with international aviation consultant Neil Hansford, who knows this space so well.
You don't often get the phrase smart-assed pimply merchant bankers on a Fear and Greed podcast, but we do in this interview. Neil, plain-spoken Neil, tells us what he really thinks about the airline industry and about who's running Rex in particular. And it is a fascinating, I mean, he's just got such great insight. He's been doing it for 40 years. He knows these airlines so well. And he doesn't always say what I expect him to say, Neil. And I learnt a lot from the interview as well, so it's definitely well worth a listen.
I think he might be the most direct person we have ever had on this show. And it's worth listening to just for that. It is coming up after the show, the interview with Neil Hansford, so stick around for that one. Turning to local markets now, Sean, how did they perform yesterday?
The S&P ASX 200 closed down 0.5% to 7,953 points, with the materials index leading the market lower, while tech stocks also underperformed. Commonwealth Bank and Westpac were higher, but National Australia Bank and ANZ were lower, the latter down more than 1%. WiseTech Global and Woodside were among poor performers, the best among the top 20 or 30 stocks outside those two banks: Telstra, CSL, Wesfarmers, Woolies, Coles and QBE. In corporate news, Ramsay Health Care dropped 3% after announcing the retirement of Chief Executive Craig McNally at the end of June 2025. The private hospital operator has appointed ex-Woolies Supermarkets Managing Director Natalie Davis to start as CEO-elect in October this year. Minor IGO rallied 3% and then fell close to 4.4%. Well, in fact, that's where it ended. It ended down 4.4%. That's after reporting higher underlying earnings. Credit Corp shares rallied 14% after its guidance came within analyst expectations. And Star Entertainment said it wasn't aware of any information that could have triggered the massive 15% jump in its share price on Monday.
What about international markets? Much going on?
Well, always, Michael, always. Oil prices are under pressure on the back of concerns about demand out of China. At one point, Brent had fallen below $80 a barrel. Gold's steady. The Aussie dollar's buying 65.5 US cents. But since you asked that is much going on question in a fairly condescending manner, if you don't mind me saying.
It's an inquisitive manner, Sean.
It is inquisitive.
Fine.
Well, I think it might be worth looking at profit seasons. They're going on in the US and Europe 2 or 3 weeks into the June quarter profit season. It's been a mixed earnings season around the world. Broadly, companies are lowering full-year sales and profit guidance as higher interest rates and weakness in China's economy hurts global consumer sentiment. But there's solid earnings growth, but I think that those outlook statements are taking the shine off the pretty good results. A number of high-profile companies have underwhelmed investors, according to a report on Reuters, including McDonald's, automakers Nissan and Tesla, consumer giants Nestle and Unilever. Now, with roughly 40% of US and European companies reporting results, earnings have come in about as expected. But, after the strong run by world equity markets, about as expected seems just a little bit disappointing. There's a bunch of big names reporting in coming days: Apple, Microsoft, Samsung, Toyota, ExxonMobil, Shell, L'Oreal and Adidas. We'll keep an eye on those, but it'll just be interesting to see if that sort of trend of solid reporting up to now, but just the future doesn't look quite as bright.
Sean, can you give us any hints as to what will be featured in the Fear and Greed weekly newsletter, which comes out
hours away?
Yeah, mere hours away. Any ideas as to what you're going to be just really unleashing upon today?
Actually, I am doing something on interest rates.
Mm-hmm.
Obviously, we have the CPI figures out today, so it's fairly clear that there'll be something on interest rates. I want to do something on earnings season as well, and have a bit of a crack at airlines too.
Oh, fantastic.
So, Michael, at least I've got some idea. This time last week, I had no idea what I was going to do.
I know. And you accused me of being condescending before, and I know there's a big risk of appearing a little bit condescending, going, you have no idea what you're going to write yet, do you?
Got any idea?
It is always worth subscribing to the Fear and Greed weekly newsletter. It is entirely free. Just head along to fearandgreed.com.au, pop your email address in, and the beauty of it is that in Fear and Greed, the podcast, you get the news. In Fear and Greed, the newsletter, you get the views. I mean, you get Sean's views. And this is going to come across as sounding really sarcastic, but I think they are really interesting views, Sean.
Good. Thank you very much. I take that as a compliment.
You took it the way it was intended, so I'm actually really pleased about that. Considering the way we've been going so far, it could have gone either way. So sign up at fearandgreed.com.au and keep your eye on your inbox around midday. It'll come through not long after the CPI figures come through. All right, we'll be back in a moment with the rest of the day's business news. Sean, BHP will spend $3.2 billion to set up a joint venture with Canada's London family to buy Toronto-listed copper miner Filocorp, which holds stakes in 2 copper projects, one Argentinian and one Chilean.
Yeah, BHP might have lost the fight for Anglo-American earlier in the year, but clearly its appetite for copper remains. It already has a 5% stake in one of the projects, the Filo del Sol, and will get part of the nearby Jose Maria. It is a long-term play. Both mines are 5,000 metres above sea level. There's absolutely no infrastructure in the region. I mean, calling them mines is probably a little ambitious because production is still expected to be years away. But the idea is that the joint venture partners build the infrastructure. they can be shared by both sites, and BHP will own a large chunk of the assets. Now, BHP has for many years it likes to spread the risk by taking interest in some of these smaller plays to see how they go. And they are high risk, but they only need one or two to really take off. And you're getting your money back for the all the others that perhaps didn't take off. Anyway, BHP's share price closed down 1.4% yesterday.
Okay, so down 1.4%, not great news, but still much, much better than Fortescue Metals trading day. Fortescue fell 10% yesterday. What was going on there?
Media reports suggest a large investor was trying to offload $1.9 billion worth of discounted stock after Monday's closing bell. Now, that's a decent chunk of the miner. The tumbling of its share price yesterday means it's down nearly 40% since early in the year.
Bit of good news for the wine sector, Sean, with data from Wine Australia showing a surge in exports to China since the abolition of tariffs in late March.
Since exports restarted, sales to China have surged from about $8 million in the 2023 financial year to $400 million last financial year. Almost all of that would have been in the June quarter. Wine worth at least $20 a bottle, not the stuff you drink, Michael, the stuff I drink, that drove the increase. Wine Australia says the sales, probably it's about restocking rather than retail sales, and consumption of domestic and imported wines in mainland China is still less than a third of what it was 6 years ago. There were 574 Australian companies exporting to mainland China last financial year, up from 115 the year before. But prior to the imposition of duties, there were about 2,000 companies exporting to mainland China. So we've still got a ways to go.
Indeed. Now, the former chief legal officer of Super Retail Group has filed proceedings in the federal court against the retailer, its chief executive and chairman, to enforce a settlement agreement relating to her dismissal.
Another saga, this one. Harmer's Workplace Lawyers is representing Rebecca Farrell, the former legal boss, and says she's a whistleblower who exposed serious corporate governance issues within the company. She claims that a settlement was reached with Super Retail on May 6 about her departure and other possible legal actions. Super Retail surprised investors in late April when it disclosed to the ASX that it expected a claim for between $30 million and $50 million to be lodged by Harmer's. This is according to a report in the AFR. The company disputes the allegations and will defend the action. Super Retail months ago said it expected the action to accuse CEO Anthony Herity of having an undisclosed intimate relationship with former head of human resources Jane Kelly, who left the business last year. It also outlined accusations of bullying and inappropriate company travel.
Building approvals tumbled 6.5% during June following a rise in May, demonstrating that the construction sector is still in the doldrums, Sean.
Sure is. The monthly result was, well below expectations. Bit of a disaster, really. The fall in total approvals was mainly driven by New South Wales, which fell 19% to under 1,600 houses. That's actually the lowest recorded figure for the state since January 2013, amid shortages of materials and labour. Private sector dwelling approvals, excluding houses in June, fell to the second lowest monthly level since January 2012. A 22% year-on-year fall came amid tough conditions for apartments due to high construction costs and interest rates. The point here is not only is it difficult to find the funds to actually build the places, it's really hard to find the labour and the materials as well. It's all coming together. It's a bit of a basket case, construction at the moment, or at least the residential construction sector. Not much good news at all.
Yeah, indeed. Now, Canberra has warned Australians in Lebanon to leave immediately amid escalating military action and concerns that flights may be hard to find as airlines scale back.
The advice from the government's Smart Traveller site yesterday says the security situation could deteriorate rapidly throughout Lebanon with little or no notice. Some airlines have already postponed or cancelled some flights, and further cancellations and disruptions could occur. Alternatively, airlines could set very high ticket prices for remaining flights. Daily military action has increased in southern Lebanon, including rocket and missile fire, as well as airstrikes out of Israel. It comes as opposition leader Peter Dutton departed Australia for an official visit to Israel. US diplomats are racing to avert a full-blown war between Israel and the Iranian-backed Lebanese movement Hezbollah after an attack on the Israeli-occupied Golan killed 12 people at the weekend. Israel and the US have blamed Hezbollah for the rocket strike, though the group itself has denied responsibility.
Okay, just returning to the airline industry, Sean, Air New Zealand, which is jointly listed on the ASX and at home, has dumped its carbon emissions reduction targets, saying they're unachievable by 2030.
The Kiwi carrier had been aiming to slash its carbon intensity by 28.9% compared to 2019 levels through the use of sustainable aviation fuel, a lower emissions aircraft and other changes. But now Air New Zealand says many of the levers needed to meet the target are outside of its control and remain challenging. Chief Executive Greg Foran said it had also become apparent in recent months that potential delays to fleet renewal plans posed an additional risk to the target's achievability. Air New Zealand has previously been one of the more outspoken carriers on sustainability issues. It was one of the first to announce plans to develop carbon-neutral aircraft for regional routes in partnership with Airbus, though I think some of that is now going by the wayside.
Okay, turning to international news now. Protests are spreading across Venezuela after President Nicolas Maduro claimed victory in a tense weekend election.
The National Electoral Authority said Mr. Maduro had won a third term with 51% of the vote, a result that extends a quarter century of socialist rule. Later, it proclaimed that Mr. Maduro would be president from 2025 to 2031, adding he had won, and I quote, the majority of valid votes. But governments in Washington and elsewhere cast doubt on the results and called for a full tabulation of votes. Independent expert polls pointed to a landslide win for the opposition. Street marches followed, including the firing of tear gas in a bid to disperse the protesters. Some very disturbing scenes in that.
Finally, Sean, the saying goes that it's good to follow the money, and it seems to have worked for people who have followed Warren Buffett's money.
Yes, so it's interesting that his company, Berkshire Hathaway, has cut its massive profitable bet on Bank of America, the US's second largest lender, by a total of more than $3 billion. The conglomerate started building an investment in the bank in 2011. It's long reigned as the top shareholder. Even after the sales, Berkshire still holds about 962 million shares worth almost $40 billion. But it is interesting that the legendary 93-year-old investor is cashing out. Bank of America's share price is up 22% this year. Maybe Warren Buffett knows something we don't.
All right, now up next is the Fear and Greed Daily interview with international aviation consultant Neil Hansford. This is not to be missed.
Nope, he lets fly on what he thinks is going on at Rex, its owners, some of the management decisions. He talks also about Virgin and Qantas, and it is a fun interview, more colourful than normal, dare I say.
Yeah, it is up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au, which is also where you sign up for the Fear and Greed free weekly newsletter coming out later today. And also, if you happen to notice the Ask Fear and Greed bonus episode that popped up in your playlist at midday yesterday, worth a listen as well. Every week, twice a week, in fact, we answer listener questions in our new bonus podcast called Ask Fear and Greed. If you have a question, send it on through via the website or go to any of the social media platforms and flick it through there, and we'll do our best to answer it, won't we, Sean?
We will. Now, Michael, whenever the newsletter comes out, I don't think newsletter. I think, how do they afford that?
Yes, because of course it's Wednesday, and that is the day that how do they afford that? I'm all about the newsletter these days, and I keep forgetting to plug How Do They Afford That. It does come out every Wednesday. It's our sister podcast featuring me and financial planner Canna Campbell, talking about all things to do with personal finance and money and making your money work harder for you. Today, Sean, we're talking about debt repayment strategies. There's a whole lot of different strategies, from like the debt avalanche and the debt snowball and a whole bunch of other ones. And we kind of go through them all one by one and kind of analyze them. And Canna, she's kind of like Neil Hansford in a way, in that she's very direct and tells me exactly what she thinks, and she doesn't hold back. So
I reckon Canna is nothing like Neil Hansford.
Well, only in the sense that she tells us what she thinks.
Plain spoken, yes.
Yes, exactly. In that respect, it's a fair comparison, I hope. And I'm sorry, Canna, or I'm sorry, Neil. If I've offended anyone, I'm sorry. Anyway, How Do They Afford That? Out today. I'll put a link in today's show notes as well. Thank you, Sean.
Thank you, Michael.
It is Wednesday, the 31st of July, 2024. Make sure you're following the podcast, and please join us online on LinkedIn, Instagram, X, TikTok, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.